First, we have Andrew Morse. He is the Senior Vice President at Global Atlantic, a leading annuity and life insurance company. In his current role, Andrew leads a team of 14 and also collaborates frequently with various functions and customers inside and outside of the company. Great to have you here, Andrew.
Thank you.
Yes, of course. Next, we have Oren Shani. Oren is a credit advisor and certified business coach with AOF. And Oren has over 10 years of experience managing businesses and advising other business owners. He started, managed, and expanded his own business, providing disability accommodations for live events across the country, and he now helps entrepreneurs launch and grow their own businesses. Hey, Oren.
Hello, thanks for having me.
Oren, I wanted to see if you could just kick us off with an overview, or what are these key documents that business owners should have in mind?
When we're talking about financial statements, there's really three primary types of financial statements that all businesses of all shapes and sizes should be mindful of and should be tracking on a regular basis. That's going to be your profit and loss, your balance sheet, and your cash flow. And I'm going to briefly talk about the differences. Cash flow tracks the movement of cash in and out of your business over an indicated period of time. I like to think of this as more of like the respiratory system of your business, right? Cash comes in, cash goes out. The business owner should really be monitoring that movement on a regular basis to optimize the health of their business. I would say this is probably the most important out of the three, just in my personal opinion, because with a profit and loss, for instance, you can still run a business with a net loss. But on a cash flow, you can't run a business without cash, right? You need cash to run a business. Cash is the fuel to this beautiful Shelby Mustang that you built, right? So the cash flow statement is important. What is it? Essentially, like I mentioned before, it monitors the movement of cash in and out of your business. The most simplest monitors the movement of cash in and out of your business. The most simplest way to think about a cash flow statement is your banking statement, right? You go into your bank account, you look at that online activity, you see cash coming in through sales, you see cash leaving through paying bills, and then at the end of that statement, you see kind of that net amount of cash left over. That's essentially a very simplified version of a cash flow statement. Now, there's a more formalized structure to it, which we'll talk about a little bit, but essentially, just conceptually speaking, that's what we're talking about here. We're talking about cash coming in, cash going out, and seeing how much cash you have or your cash position at any particular point in time. So what can a cash flow statement do for our business? It helps you identify working capital needs. A good example of this is, let's say that you just started your business, right? You're in the post-startup phase. You started generating some revenue, but you just started your business. So you're not operating at full capacity, meaning your revenues are lower and you probably still have a lot of startup expenses. So your expenses are higher. So very normal for post-startup businesses to be operating at a net loss. So instead of generating profit, their expenses are higher than their revenues. So they're operating in a net loss. And that might be okay. And that's pretty normal for new businesses. What your cash flow statement is going to do for you, it's going to help you identify how much cash you're going to need to carry you through this net loss period, so that with the intention that eventually you're going to break even and you're going to start generating a profit, but your cash flow statement is going to allow you to budget for how much cash you're going to need in the meantime until you get to that break even point. And that's a pretty standard trajectory for most new businesses. Is you're going to start your business, you're going to operate at a net loss for a while, and if you start generating profit from day one, that's great, congratulations, that's awesome. But if not, then your cash flow is going to allow you to budget for how much cash you're going to need to carry you through that net loss period. It helps you predict hard lean times for the business, and it helps you diagnose the current state of your business, and it essentially increases profitability by allowing you to understand what your cash needs are. It allows you to create a projection for what your cash needs might be, and allows you to build a budget so that you can operate your business in the most efficient way possible. So cash flow components, again, we're talking about really two things here. We're talking about all the cash coming in, and we're talking about the cash leaving, and then what's left over is your net cash flow or your cash position. Now, cash inflows. There's three primary sources for a cash inflow. One's going to be through operating activities. So when you sell products or you sell services, your customer pays you in cash, that cash goes into your bank account. That is cash inflow from operating activities, through running the operation of the business. Secondly is cash from potential investing activities. So you may have purchased some equipment, maybe some long-term assets, some property, some machinery. Cash left the accounts to purchase that, and that cash movement is, falls under the category of investing activities because you made an investment for your business to purchase some equipment or some machinery that you might be using to generate product in a more efficient way, right? And then lastly, we have cash movements from financing activities. So this relates to the use of capital. So let's say that you took out a loan, or let's say that you brought an investor in who gave you a cash infusion into the business. That cash coming in, whether it's from a lender or from an investor, is going to show up as a cash inflow from financing activities. So cash comes in and cash goes out. There's three primary categories in which there's this cash movement through operating activities, investing activities, and financing activities. For the purposes of this presentation, we'll kind of focus on just looking at two categories, which is just a general inflow of cash, whether that's through operating, financing, or investing, and then cash going out of the accounts. That's kind of how we'll look at this. But again, kind of going back to the very basic concept of a cash flow, we're looking at a cash inflow from various sources and your cash outflow from various sources, and what does that mean for your cash bottom line? What that means for what's the amount of money that's in your bank account, essentially. So just looking at a simple example here, again, very straightforward structure here. You have your cash receipts, all that cash coming in from sales. You have your cash paid out, all those bills that you have to pay, and then whatever is left over is the resulting cash position, what you have left over in the bank account after all of this cash movement. Again, cash coming in and going out can be qualified by either operating activities, investing activities, or financing activities. Which, if anyone has any questions about that or additional examples of that, I'm happy to provide that. But essentially, that's what we're looking at here. I mentioned that your cash flow is sort of kind of like the respiratory system of your business, and I really mean that. I mean, you should be monitoring your cash movements on a regular basis, because number one, you need to make sure that you have enough cash. And if you're finding certain trends or patterns in your monthly cash flows, if you see that your cash position is decreasing over time, even though you're generating revenue, but if your bottom line cash position, if your cash reserves are decreasing over time, you're noticing certain patterns, you're noticing certain trends, and you can get in front of the problem by putting certain projections together to better understand what you need to change about your business while you still have cash in the bank, to prevent yourself from getting into a position where you're going to run out of cash. The more you can prepare yourself, the more time in advance that you can see that there is a potential problem or there's a potential unsustainable decrease in cash flow, the more you can get in front of the problem and plan accordingly and make the strategic decisions that you need to make as a business owner to prevent your business from running out of cash.
Thank you to Oren and to Andrew for taking us through this conversation today and answering all those wonderful questions. We will see you in the next one. Bye.
Right.